All right. Hello, hello. Good afternoon. As everyone starts streaming in, let's just wait a couple of minutes. And today we are talking about the advanced moving average strategies. So if you're joining us now, please feel free to, if you have any questions, put it into the chat at any time. So while I'm going through the slides today, if you have any questions, put it into the chat. I'll be happy to answer your questions. And if you have any currency pairs or any instruments that you'd like me to look at, I'll be happy to go through that as well after I've gone through the slides on the advanced moving average strategies that we'll be looking at today as well. Before we get started, I'm coughing a little bit today, so bear with me as we look at if a few more people streaming in at this point. Okay. So thank you all for joining us at this session. Please, if you're joining us from any other platforms, we are here streaming live. We're on Zoom as well. If you have any questions, please feel free to put in chat. I am checking out I'm checking all the platforms or the chat platforms. So I'll be happy to help you through that. Okay, so let's get started. Well, today we are looking at the advanced moving average strategies. My name is Jindal. I'm here to help you through, guiding you through the strategies and some ideas on how to use moving average better with your overall trading strategies, how you can use it to identify trend and also possible reversal potentials, right? So as usual, a quick disclaimer before we get started. Any information, context, opinions that are expressed in this presentation and in the following slides are solely those of myself, the presenter, not necessarily those of Vantage, and are solely used only for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. So in essence, please check, do your own due diligence, make sure you manage your risk, make sure you manage your trades, make sure you be responsible for your trades as you look into the markets. If I'm sharing any possible trade setups, please make sure you do your own analysis before you jump into any trades. So with the disclaimer done, let's look at the next point. Introducing your analysts, the team here. They haven't got my picture up there, but I am one of the prop traders here with Desmond usually doing the session, but I'm standing in, jumping in to help you through the moving average strategies here. So we have Desmond, we have Cassandra, Melanie, Jianing, and Joanne as well. My picture is supposed to be right there, but we'll get that up shortly, right? So if you have any questions, again, if you're joining us, please feel free to put them into the chat. I'll be happy to guide you through those questions. So what we're going to cover today, we have quite a few points, quite a number of things to get through today. Looking at a quick introduction. First, we'll start off with a quick introduction to moving averages, right? How to use moving averages, the common ways to use moving averages, the actual tweaks, some tweaks and some ideas on how to use moving averages. Why I say tweaks is because a lot of times people use, they just jump onto the charts, drag in the first moving average they can think of, draw it in, and they use that. But there are times where you can tweak the moving average or the way to use moving average. For example, to consider a natural moving average of the market. And I'll tell you a bit more about what's a natural moving average as we go through the slides there. Following on from that, we will also be looking at identifying the different reversals with the natural moving average, and lastly, we'll be combining the analysis to find high probability reversals, right? So usually, or what I would always suggest is first approach the markets, consider it as a form of trend following first, right? As you build, because trend following, what you normally will see is that it does have a higher rate of success. We do see trend following trades working out better, about a 70 to 30%, right? 70% success rate compared to a 30% success rate on counter trend trades. But counter trend trades generally have, or rather most traders try to take a punt or take a chance on counter trend trades because they do have that chance, right? They do present a chance for good returns, for very good returns, because you see the market reverses from a trend into a counter trend scenario. We can see a chance of a small or relatively small risk compared to a relatively big reward when you look into counter trend trades. So that's also one reason why there is such a big interest on trying to find reversals. And that's what we'll be doing at the last point, combining the different moving average strategies to try and find high probability reversal setups. So what is a moving average? Doing a quick introduction. What is moving average? Moving average really is, well, you can see here, points, right? This is a 50 moving average, that's a 200 moving average. We can see it as points on the charts that actually considers the price movements from the previous periods. When we say it's something like a 50 moving average, a 50 simple moving average would mean that it calculates the average of 50 candles, right? 50 candles before that point, and it draws one dot. 50 candles before the next candle, it draws another dot, and then another dot, and then another dot. And as all the dots line up, what you get is a line, which we call the 50 moving average. Now, what would be the 200 moving average? There would be a dot drawn for 200 candles before that, right? So every 200 candles, you draw a dot. As the next candle moves along, you consider the 200 candles before that, and then a dot, and over and over and over again. And that's why we see and that's how we see the 200 moving average. What you should take note of is that moving averages is considered a lagging indicator, right? Again, moving averages is considered a lagging indicator because it moves only after price has moved. It calculates the historical movements of 50, 200, it could be 100, it could be 30, it could be any number of a moving average that you set, but it considers the past movement of moving average. So because of that, it is a lagging indicator. What you would see here, for example, is that as price shoots up, the moving average actually has not moved as much, or even at that point, as price shoots down, moving average is actually showing you possibly some flat or some upside as price moves, right? So it's still a lagging indicator. Just bear that in mind before you start considering when you see moving average turning towards the upside or turning down. Its price might have already moved before that moving average is being printed. So that's a few things, as a quick introduction. It is considering price from previous candles, 250, 130, 10, any amounts. Is considering the candles before that. And because it's considering the candles before that, it does actually have an effect of being a lagging indicator, right? But can it still tell you some possibilities into what could happen into the markets? Yes, right? It can still tell you possible movements or projections into the market. But what we do, we don't just use one moving average alone. We use a combination. We use a combination of moving average, of different moving averages. Sorry. We use a combination of different moving averages. We use a combination of other indicators as well, just to supplement the view of, the current moving average or the pairs of moving average. Why I say a pair of moving average, because like I'm showing you here, there is such thing called as the golden or the death cross. The golden cross, and to use the golden and the death cross, we're using the 200 and the 50 simple moving average here. When we see the 50 cross over the 200, that's what we call a golden cross. That's where you can see price moving towards the upside. Or when you see 50 cross down from the 200 moving average, and that's where we would say it's the death cross as we see price move towards the downside, right? You can see here as price move towards the downside, when that cross happens, or when there's a golden cross, you see price move towards the upside. But what you should also notice here is that, let me take that away, right? Is that as price moves, you would see that price has already moved down, right? It was here, it's already moved down, and where the 50 and the 200 crosses, price has already moved that much. It's already moved towards the downside. You might have already missed out on some movements, but because of that death cross, that 50 over under the 200 death cross, it gives you the indication that from that point on, right, we can see further downside because of the crossovers on the two moving averages. And you can see that with that, the 50 also becomes a little bit of a resistance as price stays below that 50 moving average. As price stays below that 50 moving average, trading towards the downside. Once price breaks back into that 50, breaks back over that 50 level, in this case here, you would say that that move has ended. That move has ended. Price has come back into that resistance area. From here on, we would say that it's a bit uncertain all the way till that point after price has shot up, and then we see that golden cross happen there. We anticipate further upside for price. And you can see again here, price testing, coming quite close, testing that support, that moving average as a support area. And once it breaks, we can think that that move has ended. So there are many ways to use moving averages here. First one that I'm sharing with you is the 50 and the 200 cross. We call it, if 50 crosses above the 200, we call it the golden cross. If 50 crosses below the 200, we call that the death cross. That's also together with, you can also see it as a momentum push, because you can see that price has already shot towards the downside before we see that cross. So this is one of the ways that you can use multiple moving averages put together to give you an indication, right? To actually show it onto the charts, make it a little bit more obvious of potential longer term trends towards either the upside or the downside, and also to signal a possible change in direction. The next thing we look at is how price crosses over the moving average. Just then, we looked at the two moving average crossing. Right now, we're looking at price crossing over the moving average. In this case, you can see that first price came up, hit that moving average, could be a 200 moving average here, hit that 200 and turned towards the downside. Moving average in this case has formed a strong, or is forming as a strong resistance pushing price towards the downside. Again, price hit, rejected, and turned towards the downside briefly before pushing up and closing above the moving average. What we're looking for is not just the tail crossing the moving average. We're looking for price to close above the moving average. I'll clean it up so it's easier to see. What we're looking for is price to close above that moving average, which gives you another hint. We give you that view that, hey, potential reversal, price has broken up from a resistance, a moving average as a resistance level, pushing towards the upside. At that point, you could be looking at a possible buying opportunity. Let's say if we're looking at this as a trading strategy, to try and keep it very simple, you could be looking at a buying opportunity there. Stop loss will be below that moving average. And then your take profit level would be, if you have the next support, or in this case, the next resistance level. We don't have the previous chart there, but you could be looking at a risk to reward level, right? A risk to reward could be 2 times your risk to reward or 3 times, depending on where that resistance level is going to be. In this case, you would see that if you bought at that point, price set across, tested the support before bouncing back up, you would have a good 1:1 based on the visual. If you didn't close out there, tested support again, and then possibly a 1:3 risk to reward towards the upside, just based on a relatively simple strategy on price crossing over a moving average line. But bear in mind, when you look at moving averages, when you look at a 50 over 200, a golden cross or the death cross, or when price crossing over a moving average line, bear in mind that you are looking at the possible only. If it's looking at a smaller time frame, it's going to be noisy. You're going to see price fluctuate around that point quite significantly. If you look at this on an H4 or on a daily time frame, the trend is more likely to be stronger. The reversal is more likely to be stronger. You're going to see that push towards the upside, right? So again, when you look at moving averages, consider it in the larger time frame. It's going to make the trend or the strategy a lot stronger than if you looked at it only on the smaller time frames. For example, on the 15-minute, 5-minute, or even a 1 minute, you're going to see that as a very noisy move compared to if you looked at it on the H1, H4, or even better still on the daily time frame. So we went through the golden cross, the death cross, and when price crosses over the moving average line, let me ask you this quick question, is that which looks better, right? If price tests, comes close again, test that level, tries to break that level, or compared to if price actually misses that level with some gap in the middle here, which will be better? Put it into the chat. Let me know. What do you think? Would 1 be better, or would number 2 be better? The fact that the price actually comes and tests that support, the moving average as a support level, or if price comes close but doesn't test, right? Comes close but does have some gap in the middle. Which would be better? Which do you think would be a better choice? All right, I see some answers there. I got a mixed bag of answers. So, just to let you know, I'll consider that this one, in this case, 1 and 2, 1 will be the better moving average, or I would say it's a stronger moving average. And this is why we consider it as a natural moving average, right? It's quite commonly, most traders or most retail traders would normally apply onto their charts a 50 SMA, right? If you apply a 50 SMA, because that's the standard. That's the standard thing that you get as you put it onto your MT4. You you look for moving average as an indicator, you drag it across onto your charts. 50 SMA is a standard one. That's what a lot of things that you read online would tell you about as well. But what we have actually done is we've tweaked it. We've looked at the 50. We've considered that price does miss that moving average a little bit, right? It does come down, it comes close, but it misses that moving average a little bit. What we actually found as a stronger indicator was when we tweaked the simple moving average, SMA, simple moving average, to a 46. So instead of considering 50 points before that candle, we've tweaked the simple moving average to consider 46 points before that candle. Why 46? That's what we actually found. We tweaked it and found that. One other considerations is also that 46 considers the overall trading days rather than weekends, as markets might be closed, or holidays and all that. So just a small tweak, not just because of the trading days, but what is also something that we've back tested and found that as price comes down on a 46 SMA to test that moving average, again, actually hits and bounces off a support level. It's like when price comes down, hits the floor and bounces off, it proves that that moving average is a stronger line compared to if price comes close but doesn't actually hit. So that might be something that you want to consider applying onto your trading strategies or tweaking your trading strategies a little bit. You might want to consider looking at the 50 SMA, but if you find that it might not be the most suitable, you might see a price missing that level a little bit, then you might want to consider tweaking your SMA slightly, making it a 46. Or if you find that on some currency pairs, maybe tweaking it to a 42 or 40, what we found was a 42 or 44 might actually work, but it's around that region. What we found that works best is the 46 SMA. So something else to consider, the natural moving average. With that as well, as we look into the different ways of looking at moving averages, you can see that if we had a moving average here, it would be pretty much along in between. Usually that moving average happens in between of the channels. You can see that channels form it's quite similar to a moving average as it tests that lower channel. This comes close, right? As it tests that lower channel, and then it bounces towards the upside. So what you normally find is that as moving average tells you a trend, the channel also tells you a trend, and then the moving average would possibly be somewhere in the middle between these points. I'm not going to try and draw a moving average between this channel, but it's possibly going to be in that region there, right? So what you try and do is you try and combine not just your moving average, but you try and put the channels into it as well. Remember that as many different analysis that you can put in, unique analysis, right? Why I stress on the unique point is that you don't want to be looking at a 50 SMA, a 42 SMA, a 46 SMA, and all the similar moving averages put together is going to tell you the same story. What you want to have is a moving average, possibly a channel, possibly the Ichimoku as well, which I'll share with you slightly later. Different analysis or different unique analysis put together, and if it tells you the same thing, that hey, price is likely to bounce off, if it tells you something like hey, price is likely to bounce off a support level there, then you're going to see a bigger move. You're going to see a bigger move as the combination of analysis gives you that confluence, gives you a confluence to show you where price is likely to be heading. So how do we do that? What you can consider is, in this case, right? In this case, we have the 200 SMA here. That's the black line and the channel, right? The 200 SMA and the channel. You can see that price respects not just the 200 SMA, not just the channel, but both together. And when you see price respecting those two indicators or those two price levels together, it gives you a little bit of confidence. It gives you, in this case, confidence that price is moving towards the upside. However, if price breaks not one, but two indicators, right? If price breaks 200 SMA and also the lower bottom end of the channel, the lower support of the channel, what's that going to tell you, right? Is it going to be a reversal towards the upside, or is it going to be a big continuation towards the downside? As it breaks two indicators, the 200 SMA and also the upward channel, right? The lower end of the lower support of the upward channel. If it breaks two, then you're likely to see a big move towards the downside, because it's telling you the same thing, right? It's telling you that price has broken not just one indicator, not just one price indicator, but it's broken two price indicators. We're going to see a big, strong downward move. That's why we call it a double break. It's not just broken one, it's broken two indicators. And that's why you see that big move. So what you want to try and do in this case is not just have the 200 SMA, right? We told you about 200 SMA, about price breaking or crossing the moving average. You don't want to just have that. You want to consider price with the SMA and also possibly a channel, possibly some other indicators that can give you that confirmation or that little bit more confidence as price breaks from two indicators towards the downside. That's what we call a little bit of a confluence as well, right? When you have an upward channel and then you have an upward channel together with the 200 SMA, is when you have a confluence of ideas, a confluence of signals. If price test those points, you're going to find, again, this is a repeat, you're going to find that confidence or that confluence towards the upside. You can always add in more ideas as well, or more price indicators as well. Further confluence, right? Further confluence when you have the 200 SMA, the upward channel, and the Ichimoku cloud right below price, showing you that price is pushing towards the upside. So we're looking at many ways to use the moving average, not just the moving average alone, but the moving average together with other indicators. In this case, we can also add in the 50 moving average, and you can see here coming quite close, the 50 crossing over the 200. I think in this case, this was the natural moving average. Natural moving average. The black line there. In this case, this was a 200 moving average over the 50. Take that away so that you can see easier. Have an easier look. That's a crossover. So not just, in this case, not just price resisting the natural moving average or being supported by the natural moving average, price being supported by the channel, price being supported by the Ichimoku cloud towards the upside, price also reacting to a crossover on the golden crossover by the 50 and the 200 moving average. Bear in mind that in this case, if I drew a straight line, I'll try to draw a straight line up, you wouldn't be looking to buy straight away. Right? You wouldn't be looking to buy straight away because price has been moving towards the downside. Although there is a crossover, what you want is that confluence. You want that confluence. You're looking for a buying opportunity at that point as price gets supported, and also seeing that crossover. If you get in at that point, then it is about the entry towards the upside, towards that resistance level. So if you just jumped onto the trade just because of a golden cross, right? If you jumped into the trade just because of the golden cross, what could happen is, oops, that's a terrible line, beg your pardon. If you jumped into a trade just because of a golden cross 50 over the 200, what you notice is that you wouldn't be very confident with the trade, because you get in there, you'll see the trade immediately go towards the downside. You'll be losing profits, or you'll be losing money, losing that trade before it bounces back up, and then you could be making money there. But during that period when it's dropping, when it's moving towards the downside, you'll be losing confidence. You'll be wondering whether, a 50 over 200 SMA cross really does work or not. All right. So don't just use one moving average strategy alone. Build that confluence. Look at the possible combinations. In this case, the natural moving average. Look for it to come back down. Look at trend as well, because you can see that in the short term, trend has been coming towards the downside. Look for a bounce before buying towards upside. And in this case here, you'd see that if you got into that trade, it is just about the upside, rather than looking at price come below your entry point, causing that uncertainty, causing that loss of confidence. So confluence here is a combination of price indicators, is a combination of other indicators put together to help you find that entry point, not just to help you find an entry point, but to help you find an entry point that could give you additional confidence when you jump into the trade. All right. So what we're going to try and do is we're going to try and find trades that will give us a combination or confluence of ideas to help us find that sweet spot, that possible reversal, or that possible trend following scenario towards the upside or the downside. So this is how it looks. We have, as I was just showing you, trend or channels towards the upside. We have moving average, the 200 here. All right, we have the 50 here. We have the natural moving average here, and then we have the Ichimoku here as well. So you put it all together, and it tells you that strong picture towards upside, or if price breaks, let's say for example price breaks towards the downside, that's going to give you a confluence of ideas or confluence of a potential reversal or potential counter trend scenario for as price breaks not just one, not just two, but possibly 3 or 4 price indicators. You're going to see a big strong downward move towards the downside. With that, let me see if I've got any questions from attendees. So far so good, everyone's quite happy. What I'll do next is I will look into some possible trades or some possible setups, some trade ideas. Let me just share that with you. So here we're looking at I'll start off with the US CAD. No, actually I'll start off with the Aussie dollar first. Right, looking at the Aussie dollar, what I'll do is I'll put in actually, while I have it here, let me just show you a couple of other moving averages that you could look into, you could use. Here we do have the moving average ribbon, right? So I'll take these lines away just to keep it a bit simple, right? The moving average ribbon. So what is the moving average ribbon? It is one of another scenario where you're combining several different moving averages here. You can see that we have a simple moving average on 20, a 20 simple moving average, a 50 simple moving average, 100, and a 200 simple moving average, right? So again, does it look familiar when we have the 50 and the 200? That's the death cross or the golden cross when it crosses over each other. We do, in this case, also consider in the shorter term that 20, it's going to be more volatile. It's going to move around a lot more. And also the 100 SMA, where it considers a little bit more of a smoother direction or a smoother move compared to in between that 50 and that 200, right? So just remember the colors there: yellow for 20, orange for 50, slightly darker orange for 100, and red for 200. In this case, you can see that's the 200, that's the 100, that's the 50, and that's the 20 there. So what you should notice here is that as we have not just the, let me just make it a little bit easier for you to see. I'll just change this for now to a green, blue, and that one is a green. See, that's how easy you can change your simple moving average as well, just by changing the different colors there or numbers there. That, and also let's consider that one, something different that we can spot easily. All right, so you can see here that we do have the 200 crossing over the 50, crossing over the 200 here. The 50 crossing over 200, and that's what led to, you can see that price moving down. That's one example of the death cross, but you can also see that with the 100 and also the 20 there, that happened a little bit earlier, and that showed us that move. So you can put that together, you can put it together, and you can see that move happening on that 100 and 20, 100 crossover with the 20, or 20 crossover with the 100, and the 50 crossover with the 200, showing you that downside potential. And if we look at it here, once it starts crossing back up, you can see that price push towards the upside. As I scroll along, just to give you some other examples, when we have all the 20, 50, 100, and 200 moving averages pointing towards the downside, you can see that it's a good strong move towards the downside on price. And if we move right across again, you can see price supported by the moving average pushing towards upside. Now let me show you one example. This is on the H4 time frame. If we looked at the price on the M15, you notice that price tends to break out of that support level or break below that moving average before spiking back in again, breaking below, showing like it's likely to form a big downside before spiking back up again, breaking strongly before spiking back up again. So this, again, I'll show you this to highlight the point, especially here you can see a big strong break before bouncing back up. This is to highlight the point that when you look at, moving averages, or you look at any indicators, in fact, it's going to be a lot noisier on price and indicators in the smaller time frame compared to if you looked at it on the H4 or on a daily time frame. Prices like that are possibly going to be heavily influenced by news events, sentiment and big news events, which caused a spike. And because moving average is a lagging indicator, it fails to consider that big spike. It's only been counting the 20, the 50, the 100, or the 200 candles before that. So that's why it's still lagging at that point. It's still telling you that it's pushing towards the upside. A lot of indicators, a lot of moving average there telling you it's still pointing towards the upside. but it pushes back down. And when it's even crossed towards the downside, quite a number of them are still looking at some upward potential. So again, just be extra careful when you look at using or applying moving averages. It is a lagging indicator. If you look at a moving average ribbon, what you want to be looking for in this case, for example, in the H1 time frame, you want price in the best case scenario to be supported or to be resisted by the long-term moving average, right? In this case, that 200 level, right? You want price to be resisted by the 200 level. And then you want also, or as much as possible, all the moving averages to point towards the same direction. In this case, you can see that for a 50 and a 200 crossover, you see a 50 and a 200 crossover there. We want everything pointing towards the upside. No way. A 50 and a 200 crossover there pointing towards the upside to show us that golden cross, to show us everything pointing to upside. You see that big upward move on the Aussie dollar here on the H1 time frame. We looked at the pound dollar, for example, right? No, actually, I'll go back to the Aussie just because there's 20 lines here. There's another one I want to show you. It's also the guppy, right? Guppy. What's a guppy? Sounds good. It is a combination. There's many moving averages put together, right? These are moving averages on different periods. But this is not on the SMA. The guppy considers the moving average on the EMA. That's an exponential moving average on different periods and on different lengths as well. So when we look at the guppy, what we want to consider is that we want all the moving averages, or the blue ones and the red ones. I'll show you here again. The blue ones are the 1, 2, 3, 4, 5, 6 EMAs, and then that's they call it the trader and investor EMAs to show you the longer and the shorter term moves. We want price. Again, you can see how in this case price being supported by that red one, by the red moving averages here being supported. And once it breaks down, you consider that as a possible reversal, but you wouldn't do it yet unless the blue moving averages or the blue EMAs cross down towards the downside, in this case like that, right? So we look at this as another indicator, as another moving average indicator to show us a potential reversal. In this case, you can see that price, as it stays within that blue area, within all that combination of moving averages, and it stays above the red EMAs here, a strong move towards the upside. But once it crosses over, once the blue series of EMAs crosses over the red, you can see that push, strong push towards the downside. Once it comes back in, no clear direction because it fluctuates within this area, no clear directions. Once it pushes out, or once there's a gap, strong gap between the red, the trader and the investor EMAs here, you can see a strong move towards the upside. In this case, back to nothing, back to no bias, no directional bias. And then once it pushes towards upside again, you can see that move higher. Again, nothing there before a push higher again. So many ways or many different moving averages to use here, not just a single moving average, not just a simple moving average. We have the exponential moving averages. We have the combination of moving averages, crossovers, and as price crosses over the moving average. In this case, look out, right? We have the Aussie US on the H1 time frame possibly crossing below the investor EMAs here, which could signal a potential strong reversal towards the downside. What you would need, or what you'll be looking for here in this case, will be for price to break lower, right? You'll be looking for price to break lower, but you'll also be looking for the trader EMAs to trade below the red or the investor EMAs here. In this case, for example, like that. You'll be looking for a scenario like that where it crosses over. That's going to show you that downside move, right? So something to watch out for here on the Aussie dollar on the H1 time frame. Bear in mind that this is a counter trend setup. So as I was just sharing with you at the start of the session, counter trend setups are more risky. They do tend to have more chance of a failing. So please, again, disclaimer applies. Do your own analysis. Make sure you manage your trade size, your trade risk before you jump into any trades, right? With that, let's apply this onto the euro dollar. So you can see that the euro dollar using the guppy moving average indicators here, we haven't seen, right? No clear directions in this point. So that's why the price of the euro dollar has been fluctuating between that 1.0250 and to a lower extent at 1.012, but actually you can even consider it at 1.017 level, right? So you can see price fluctuating between that point because there isn't any clear directions on the guppy moving averages here. What we're looking for, possibly within the next couple of minutes, if its price closes lower, if price closes towards the downside, we might see this forming up. We might see the the blue trader EMAs forming below the red investor EMAs to push price towards the downside. You can see that if I took that away, put in the MA ribbons there, you can see that price is coming close to that 200 SMA. Again, it's a quick reminder, what happens if price breaks lower and closes below that 200 SMA? We could possibly see this as a scenario with price breaking the moving average, which could signal further downside, a strong reversal towards the downside for the euro dollar. Right, so in this case, what I also try and do is to add in where is it? Bit of a channel there. Okay, put a channel there. You can see that price is also breaking, looking to break below that bottom range or the bottom support level of the channel. If it does break down and breaks below that level, we can see possibly price trading lower. What I'll do here as well is to apply what we just spoke about. Oops. Let me just take that away. Do that one. All right, so oops, that's not right. Yeah, okay, that's right. So, as you can see, price now trading towards the downside. I'll put in one more there. Right, 200. Why is it not changing? Take that away. Okay, put that one in there. Okay, there you go. That's my 200. I'll put in one more. Actually, I'll change this one to a 46. And we're just talking about that's a natural moving average. So what you see is that price has broken below that natural moving average. This was moving across. If I change that to the 200, you can see that it's approaching that 200 level. So as we look at this now on the euro dollar, we could be looking at price now breaking that support level, possibly approaching and possibly breaking that 200 moving average. Can we see possibly with price trading lower, maybe towards that parity level again? What needs to happen for what needs to happen for the euro dollar trade that significantly to the downside? Possibly we're going to need to see some news on the euro dollar, or for the dollar index to trade towards the upside, right? We need dollar index to trade towards the upside, possibly towards that 107 level. You can see that 200. I'll put in one more moving average. And I'll change that to the 50. You can see that because of that cross towards the downside, we've seen that big move on the dollar index towards the downside. Right now, sitting across, you can see that the downward move on the 50 SMA has slowed down. We're looking for this to push. And if we do see that in this case, now, if we see the 50 SMA sit right there, and then the 200 comes back down, and we see a crossover, we're likely to see the dollar index push towards the upside. All right, so it's already happening right now. I think that for this crossover to happen here, that would possibly push price above that 107 level. So we're seeing price now push towards the upside. We need to see it crossover to push above that 107, possibly towards the 109 level here that we've got, or the recent high from the dollar index. I'm not sure whether it'll get to 109 immediately, but I would say that it would take some time, possibly with the news coming out on Thursday from the Federal Reserve. Question there is, what's the natural moving average? Natural moving average, I was just sharing just then on the slides, is that we consider not just the moving average on a 50 simple moving average, we consider it on a 46 simple moving average. So we've tweaked it slightly just so that we can see it, test the levels or that moving average more closely, rather than the 50 where it kind of misses some of the simple or some of the moving average lines, or where price test or doesn't test the simple moving average lines as closely. So that's one of the tweaks that we've made to the moving average by considering a natural moving average, looking at it on a 46 period rather than on a 50. All right, I hope it answers your question there, Zoran. Thanks for that. Let's look at one or two more pairs. We see the I like putting the channels in because it gives you quite a good view here. You can see that in this case, we can see a possible break as well, a possible break. In this case, price is already crossing below the moving average there. So again, everything seems to be setting up. Just be careful right now, because everything seems to be setting up for a quick reversal. It could happen. It could just spike down and push straight back up again. So just be careful. We do have the other moving averages there. I would also be keen to find out what happens or what's pushing price. In this case, you can see that the pound dollar was trading towards the upside, right now trading significantly lower, but you also want to consider as it breaks that moving average. Which one is this? The 50 moving average could signal further downside, but you want price to close below that point. You also want it to track down, maybe for the 50 to track lower, 200 to sit right across. If we see a big crossover, could see further downside. But I have my support resistance lines in there as well. I'll look for price. The first move could be down towards the 1.1940 level. Further move towards the downside would have to break that support level, and also possibly that channel as well. So what you see here is that got to do my upper channel better there, right? What you see is that moving average, the 200 will be sitting right at that point. So we do see price track lower right now at 1.2010. If it comes down towards 1.1970, we could see it come close or break that confluence of a moving average together with the channel. That point, circle it here. That point there could be quite crucial. We could see price track down, and if it breaks past this point, we could see big downside, especially if it breaks past that support level as well. So putting a few things together, moving average first already broken there, breaking below the channel, breaking below the next moving average, the 200 moving average there, breaking below or potentially breaking below a support level, which was tested several times over the last couple of weeks. If all that breaks, we can possibly see the pound dollar track significantly lower. I wouldn't say it'll go down to 1.1780. I would say that we do have a few other levels to consider, but it could have a significant downside. All right, so something to consider, something to look at there on the pound dollar. So a lot of price movements happening right now. I think that just be extra careful, wait for the hour to close, look to see what happens here. Aussie dollar looking like it's coming back down towards that moving average. Is it going to stay supported or is it going to bounce? Watch out for that. The US yen, we saw that crossover. That's why we saw the big drop in the US yen. Right now, trading back into that 136.60 resistance level. Let's see what happens there. This is a analysis that I did before. I have been waiting to see if it's going to break above 136.80 before a potential buying opportunity towards upside, with 137.70 as a interim level before 139 as the ultimate take profit level there, right? So I hope that so far what we've been going through, the different ways of looking at moving average, the golden cross, the natural moving average. We had a question there about the natural moving average. We've had the views of a confluence, right, using the channels to form that confluence together with the moving average. We've seen the confluence together with the Ichimoku cloud as well, looking at double breaks as price breaks not just the moving average but the channel. We've seen quite a few examples or potential examples of that happening. One being here, where we see price, if it continues towards the downside, it's going to break that channel together with the moving average. Building that confluence, we could see significant downside, right? So again, I hope you enjoyed the session today. We look at the advanced ways to look at moving averages. Bear in mind that it is a lagging indicator. It is considering price movements or price points from previous candles. So don't just jump into any trades straight away because of the moving average. You try and build that confluence with a series of other unique indicators to help you or to guide you towards better trade setups, trend following trade setups, or counter trend. In this case, we can see a potential counter trend trade setup forming up. All right. So with that, thank you all for attending the session. If you have any questions, please feel free to reach out and to let us know if you have any questions or if there's anything else we can help you with. With that, trade well, trade safe, and I'll see you again. Take care now. Bye-bye.